What if I told you that waiting until you have more money is one of the biggest investing mistakes beginners make right here in the UK? And guess what? You can absolutely get started today with just £50, no matter your current savings level. Whether you have a little spare change or you are finally ready to take the plunge, this essential guide has got you completely covered. Step by step, we will break down the entire process so you can immediately start building a stronger financial future. First things first, let us seriously discuss why investing is such a fundamental game changer for your money. You see, simply leaving your hard-earned money to sit stagnant in a traditional bank account means you are actively missing out on potential growth. That sneaky little thing we call inflation can slowly but surely eat away at the real purchasing power of your hard-saved cash. Investing is essentially giving your money the best chance to go to work for you, multiply, and grow healthily over the long term. But hey, let's be clear. This is not about impulsively throwing your entire life savings into the volatile stock market right away. We are intentionally starting small and sensibly, so please remember that critical point as we move along. Okay, let us begin with step 1, gaining absolute clarity on your specific investment goals for the future. You need to ask yourself, are you investing for a comfortable retirement, a future vehicle, or just educational purposes? Your defined goals will invariably shape and guide the entire investment strategy you ultimately decide to follow. If your goal is short-term, for example, you should wisely choose to adopt a much more cautious and stable approach. However, if you are in it for the very long haul, such as decades until retirement, you can afford to embrace slightly more calculated risk. Remember this crucial lesson. Clarity of purpose is the actual power that drives successful long-term financial decisions. It is also incredibly important to understand that you do not need to consistently beat the entire market to be deemed a success. Many newcomers think they must find that singular, mythical, next big stock, or perfectly time every single market move. In reality, the majority of even professional investors struggle to consistently outperform the broad market averages over time. A simple, broad, and well-diversified approach will often handily outperform far more complex strategies in the long run. Let us now expand further on diversification, because this is the area where beginners truly protect their capital. When you invest every single pound into just one company, one sector, or one single idea, you are needlessly taking on extreme risk. Diversified funds, such as index funds or popular ETFs, expertly spread your money across countless companies and even multiple countries. That simple act ensures that if one specific company stumbles, your entire investment principal is not instantly wiped clean. Another incredibly powerful habit you should strive to build into your routine early is setting up investment automation. Once you are completely comfortable, scheduling automatic monthly investments, even just £25, removes emotion from the equation. You consistently invest whether the broader market is currently experiencing a high or a significant low. This naturally enforces the fantastic strategy known as pound cost averaging, which smooths out your entry price over time. Over the long run, this disciplined approach helps reduce overall volatility and significantly lowers the stress of trying to time decisions. We must also talk extensively about patience, because investing ultimately rewards those who remain calm during any market downturns. Market corrections and even sharp crashes are not personal failures. They are historical, expected parts of the investment process. Historically speaking, markets have always demonstrated an ability to recover given a sufficient amount of time to do so. Beginners who react emotionally by panic selling often end up permanently locking in their paper losses. Conversely, those who successfully stay invested are the ones who truly benefit when the inevitable market recoveries take hold. As you diligently continue your investing practice, ongoing education will quickly become your single most valuable asset. You definitely do not need to memorize complex financial textbooks, but understanding basics will drastically improve your outcomes. Grasping foundational concepts like compound interest, fees, and inherent risk dramatically reduces the entire intimidating factor. Next up, we must address fees because they are the silent killer that aggressively eats away at your final returns. Even seemingly minuscule platform or fund fees will compound negatively against your money over the span of several decades. This is precisely why choosing platforms and funds with demonstrably low-cost structures is so important when starting small. Always scrutinize the stated annual fees and ensure you fully comprehend exactly what service you are paying that money for. Finally, please internalize this key point: successful investing is absolutely not a journey about achieving unattainable perfection. You will inevitably make mistakes along the way, as every single successful investor has done before you. What fundamentally matters is your commitment to staying consistent, learning from the experience, and preventing fear from stopping your start. That very first £50 investment you make is not really about the immediate monetary return. It is purely about building momentum. By simply taking that critical first action, you are doing something most people, unfortunately, never get around to doing. You are actively choosing long-term financial progress over the easy comfort of staying exactly where you are right now. That single decision, when repeated consistently over many years, is the proven mechanism that builds genuine, lasting wealth. Your personal investing journey does not commence when you suddenly have more money. It begins the moment you decide to start today. Let us address risk head-on, because every single investment option inherently comes with some level of potential downside. Stocks are designed to fluctuate, meaning they can certainly move up significantly, but they can also move down just as easily. The real secret is genuinely understanding your personal risk tolerance and how much market movement you can comfortably stomach. Knowing your true tolerance level will ultimately help you sleep much better at night, regardless of what the markets are doing. Most people wrongly assume that investing is strictly reserved for those with high salaries or advanced financial degrees. That single limiting belief has cost everyday people years, sometimes even decades, of crucial missed financial growth. The undeniable truth is that successful investing is far less about the amount you start with and infinitely more about the act of starting. In the modern environment, you can officially begin your UK investing journey with only £50, free from hype or complicated jargon. The true compounding power of investing comes predominantly from time and disciplined consistency, not from securing massive lump sums initially. Starting small grants you the vital opportunity to safely observe how markets operate and to understand your own emotional reactions to money. Think of your first £50 not as a ticket to instant riches, but rather as the essential tuition fee for learning how money truly works. One of the largest mental hurdles beginners face is the paralyzing fear of immediately doing it wrong, which is entirely normal. Markets constantly move up and down. Headlines are often noisy, but long-term investing success is actually quite boring in nature. It is slow, it is incredibly steady, and it requires discipline, which is precisely why this method reliably works so well over time. Right, let us transition now to step 2. Making the informed choice about precisely where you want to place your capital. The UK market offers numerous excellent options, ranging from individual stocks to bonds and diversified funds like ETFs. For example, buying a stock means acquiring a small, fractional piece of an actual operating business, whose success you share. Bonds, conversely, are generally considered more stable, because you are essentially lending money to a reliable entity. ETFs and mutual funds provide a fantastic basket of goodies approach, effortlessly spreading your risk across many different assets. You might be thinking right now, £50 sounds great, but is that actually enough money to make a difference? The answer is a resounding yes, because many UK platforms expertly allow you to buy fractional shares of expensive companies. This feature is a perfect, low-pressure way to dip your toes into the water without committing significant capital up front. Step 3 involves opening your essential brokerage account, which functions as your personal gateway to the financial markets. When researching platforms, you must prioritize ease of use in the interface alongside a commitment to very low ongoing fees. Some brokers even offer risk-free demo accounts, giving you a chance to practice trading before committing any actual money. Once you successfully select and open your chosen platform, the next logical action is to securely fund your new account. That £50 is your initial seed money, and you can always choose to add more later as your comfort level naturally increases. Step 4 is crucial. Dedicate time to solid research, because knowledge is the undisputed superpower in this entire domain. Begin by learning about the fundamental health, past performance, and future outlook of any company that interests you. If you are leaning towards funds, you must perform a deep examination of the underlying assets they currently hold within them. Never ever allow yourself to put all of your hard-earned investment eggs into one single, highly concentrated basket. Now, let us quickly tackle the perennial question. What is actually the absolute best time to initiate an investment? Honestly, there is no perfectly predictable, single right answer, as even experts consistently fail at precise market timing. A far more robust and proven strategy involves consistently deploying a fixed amount of money, regardless of market conditions. Step 5 is the moment of truth, making that very first real investment transaction and pulling the digital trigger. It might feel a little intimidating or even scary at first, but remember, you are starting small to gain invaluable confidence. Once that first trade has successfully executed, give yourself a genuine congratulation, because you are officially an investor now. Another crucial financial point beginners frequently overlook is how inflation silently diminishes the value of any held cash. Investing remains one of the most realistic ways for everyday people to fight back and realistically stay ahead of that purchasing power decline. Let us discuss mindset, because successful investing is truly as much a psychological endeavor as it is a purely financial one. Starting with a small amount like £50 instantly removes a huge amount of performance-related pressure from your shoulders. You transition from panicking over every tiny market, move to calmly observing, learning, and building essential confidence. That hard-earned confidence is exactly what allows you to deploy significantly larger sums later, without making purely emotional trades. As your investments begin to grow, keep a sensible eye on their performance, but avoid obsessing over the minute daily fluctuations. Check in periodically to ensure your portfolio still generally aligns with your established long-term financial goals, and adjust if needed. Finally, we must briefly touch upon the UK tax implications, specifically your personal allowances for gains and dividends. If your investment profits exceed those allowances, you will naturally be liable to pay some tax on the surplus gains. This is why utilizing an ESA, or individual savings account, is such a brilliant strategy for nearly every UK investor. With a stocks and shares ES, all the capital gains and dividends you generate are completely sheltered from any UK tax liability. And there you have the complete breakdown. Starting with just £50 might seem insignificant, but it is truly the first step on a long journey. Investing is a skill that requires significant time and patience. But the earlier you begin, the more time your money has to effectively compound. So, I have to ask you, what exactly are you waiting for when you already possess the initial capital to begin right now? Dive in today, commit to starting small, and watch your personal financial future begin the process of taking definite shape. Never forget the fundamental truth. Every single investing expert you admire was once a complete beginner just like you. Your specific investing journey does not start when you miraculously have more money. It starts the very second you decide to take action.